Did you know that 2 simple ETFs could potentially transform your financial future? It sounds intriguing, doesn't it? Today, we're embarking on a financial hero's journey, exploring a strategy that's been quietly outperforming the market for years. You'll discover how combining steady dividend income with tech stock growth potential could be your path to wealth. We'll break down this powerful approach, showing you how it could turn a $100,000 investment into over $1 million in just 25 years. Ready to uncover the secrets of this 2 ETF portfolio and learn how it could dramatically impact your investment goals? Let's dive in and explore this game-changing strategy together. Did you know that you could potentially outperform the entire stock market with just 2 ETFs? It sounds almost too good to be true, but let's explore this fascinating strategy that's changing the game for investors everywhere. Imagine walking into a buffet with hundreds of dishes. Overwhelming, right? That's how many people feel when they start investing. There are thousands of stocks, bonds, and funds to choose from. But what if you only needed to pick 2 items from this vast financial buffet to create a powerful investment meal? This is where the 2 ETF portfolio comes in. It's like crafting the perfect plate at our investment buffet. You've got your main course, a growth ETF that serves up the potential for substantial returns. Then there's your side dish, a dividend ETF that offers a steady stream of income and adds stability to your plate. You might be wondering, can something this simple really work? The answer might surprise you. Historical data shows that some 2 ETF combinations have actually outperformed the S&P 500 over the past decade. That's right, 2 carefully chosen ETFs could potentially beat the performance of 500 of America's largest companies. This approach simplifies your investment journey. Many investors find themselves juggling multiple ETFs, like trying to balance 10 different dishes on one plate. With the 2 ETF strategy, you're focusing on mastering just 2 key ingredients. Let's break it down further. The growth ETF is like the protein in your meal. It helps your portfolio bulk up over time. It gives you access to companies with high growth potential. The dividend ETF is like your vegetables, providing essential nutrients in the form of regular income and lower volatility. This balanced approach suits a wide range of investors. For beginners, it's a straightforward way to start investing without getting overwhelmed. For experienced investors, it can streamline your portfolio and potentially boost returns. The real kicker? This strategy could help you build wealth faster than traditional methods. By focusing on 2 powerful ETFs, you're setting the stage for potentially higher returns and steady growth over the long term. Now, you're probably curious about which 2 ETFs to choose. We've got 4 unique combinations lined up, each with its own flavor profile. Will it be a spicy growth blend or a more conservative income mix? Stay tuned as we explore these mouth-watering investment recipes in our next course. Meet Sarah, a 35-year-old teacher who discovered the power of dividend ETFs. She started investing $200 a month 5 years ago and now receives quarterly dividend payments that cover her phone bill. This is the real-world impact of dividend investing. Dividend ETFs offer a unique blend of stability and growth potential, often outperforming inflation and rivaling the S&P 500. These funds invest in dividend-paying stocks from established companies like Coca-Cola and Home Depot, known for their financial health and consistent cash flow. But what exactly are dividends? They're a portion of a company's profits paid to shareholders, typically quarterly. The amount is based on the company's earnings and payout ratio. For example, if a company earns $1 per share and has a 50% payout ratio, it would distribute 50 cents per share as a dividend. Over the past decade, some dividend ETFs have matched or even beaten the S&P 500. For instance, the Vanguard Dividend Appreciation ETF, VIG, returned 11.2% annually from 2011 to 2021, compared to the S&P 500's 11.4%. More impressively, many dividend ETFs have shown growth rates outpacing inflation, which averaged 2.1% during the same period. This performance illustrates the potential of dividend ETFs to deliver solid returns while providing income. It's like having a raise built into your investment strategy. Imagine investing in a dividend ETF 10 years ago. Not only would your investment have grown, but you'd have received increasing dividend payments, potentially outpacing the rising cost of living. Dividend ETFs shine during market downturns too. When stock prices fluctuate, many companies strive to maintain dividend payments, providing stability and income even in tough times. This makes dividend ETFs appealing to both conservative and aggressive investors. Some top-performing dividend ETFs include DGRW, SCHD, and VIG. These funds have shown resilience and strong returns even in challenging market conditions, becoming quiet wealth builders in many successful portfolios. By combining dividend income with potential capital appreciation, dividend ETFs offer a balanced approach to investing. They're not just a shield against market volatility, they're a tool for building long-term wealth, providing both growth and income potential in a single investment vehicle. This combination creates a financial fortress that not only protects your investments, but also pays you while you wait, making dividend ETFs a crucial component of a balanced investment strategy. Imagine embarking on a thrilling expedition through uncharted financial territory. That's what growth ETFs offer, a powerful vehicle to potentially accelerate your wealth-building journey. These ETFs are designed to capture the explosive potential of innovative companies that are reshaping industries and driving massive returns. Growth ETFs focus on businesses reinvesting profits into expansion rather than paying dividends. Think of companies like Amazon, Tesla, or Nvidia, firms that have transformed entire sectors. But here's the crucial part. These investments come with higher volatility, measured by their beta. A beta greater than 1 means the ETF is likely to amplify market movements both up and down. Let's look at a real example. The Vanguard Information Technology ETF, VGT, and the Technology Select Sector SPDR Fund, XLT, have been among the highest gainers in the growth ETF category. These funds have benefited from the stellar performance of technology stocks, particularly in the red-hot semiconductor sector. However, during market downturns, they can experience significant losses. Growth ETFs allow you to tap into innovation across various sectors. From cutting-edge healthcare advancements to revolutionary consumer products, these funds give you exposure to the future of business. The power of compound growth makes this strategy even more compelling. Over time, even a small increase in annual returns can lead to dramatically different outcomes. Consider this: achieving a 14% average return over 25 years could potentially help you reach millionaire status faster than settling for the S&P 500's historical average of around 10%. However, it's crucial to understand the risks involved. The NASDAQ 100, for instance, once experienced an 81% drawdown, taking over 14 years to fully recover. This is where our 2 ETF strategy shines. By combining a growth ETF with a dividend ETF, you're creating a balanced approach that can potentially outperform the broader market while managing risk. Some specific combinations of growth and dividend ETFs have achieved average returns of 14.3 to 15.8% per year over nearly a decade, a significant edge over the S&P 500's performance. Remember, growth investing isn't for the faint of heart. It requires patience, risk tolerance, and a long-term perspective. But for those willing to embrace the journey, the potential rewards can be substantial. Meet Sarah, a savvy investor who discovered the power of combining growth and dividend ETFs. Her portfolio not only provided steady income, but also captured explosive growth opportunities. Sarah's success story illustrates how blending these 2 powerful ingredients can create a portfolio that's greater than the sum of its parts. Sarah's strategy involved allocating her investments between growth and dividend ETFs, creating a portfolio that adapts to various market conditions. The dividend component provided stability and a steady income stream, while the growth component allowed her to capitalize on market gains. Let's look at the numbers. Historical performance data shows that a portfolio with a 50% allocation to a growth ETF and a 50% allocation to a dividend ETF achieved an average return of 15.8% per year. That's significantly higher than the average return of the S&P 500 over the same period. Imagine starting with $10,000 per year using this 2 ETF strategy. With an average return of 14%, you could potentially reach millionaire status in just 25 years. That's faster than you might achieve by investing solely in the S&P 500, which has historically returned around 10% on average. This strategy isn't just about chasing higher returns. It's about creating a more resilient portfolio that can weather different market conditions. Picture a seesaw. When growth stocks are soaring, your growth ETF rises. And when the market gets choppy, your dividend ETF provides balance with steady income and potentially lower volatility. Maintaining this balance requires regular rebalancing. Sarah reviews her portfolio quarterly and rebalances if the allocation strays more than 5% from her target. She sells some of her outperforming ETF and buys more of the underperforming one to maintain her desired split. There are several rebalancing methods. 1. Calendar rebalancing. Adjusting at set intervals, e.g., quarterly or annually. 2. Threshold rebalancing. Rebalancing when allocations drift beyond a certain percentage. 3. Constant mix strategy. Continuously rebalancing to maintain target weights. The beauty of this strategy lies in its flexibility. You can adjust the allocation based on your personal risk tolerance and investment goals. Some investors might prefer a 60-40 split, favoring growth, while others might lean more towards dividends with a 40-60 split. Remember, combining growth and dividend ETFs isn't a set-it-and-forget-it approach. It requires ongoing attention and adjustments to ensure your portfolio remains aligned with your financial objectives. Ready to discover the ETF combinations that could supercharge your portfolio? We're about to unveil 3 powerful pairings that have consistently outperformed the market. But before we reveal the winners, let's set the stage. These combinations have been tested over the past decade, a period marked by both bull and bear markets, economic uncertainties, and technological disruptions. Each pairing offers a unique blend of growth potential and dividend stability. But which one will be the perfect match for your investment goals? First up, we have the Vanguard High Dividend Yield ETF, VYM, paired with the Invesco QQQ Trust, QQQ. This duo combines high-yield dividends with tech-heavy NASDAQ stocks. Over the past 10 years, it achieved an impressive average portfolio return of 15.8% per year, surpassing the S&P 500 by 2.8%. The VYM provides stability with a beta of 0.83, while QQQ offers exposure to innovative companies driving market growth. Our second contender is the Schwab U.S. Dividend Equity ETF, SCHD, combined with the Schwab U.S. Large Cap Growth ETF, SCHG. This pairing offers a mix of steady dividend growth and exposure to large cap growth stocks. It delivered a 14.3% average annual return, beating the S&P 500 by 1.3%. It also boasts a dividend yield of 1.93%, higher than the S&P 500's current 1.3%. The third option pairs the Invesco QQQ Trust, QQQ, with the iShares Core Dividend Growth ETF, DGRO. This high-octane combination aims to capture the best of both worlds, the aggressive growth of tech stocks and the steady increase of dividend payouts. It achieved a 15.4% average annual return, but experienced the highest drawdown at 25.6%. It's not for the faint of heart, though. Now let's compare these combinations in terms of risk and reward. The Vanguard combo VYM and QQQ offers a sweet spot of high returns with moderate risk. The Schwab pairing, SCHD and SCHG, provides a more conservative approach with solid returns and lower volatility. Meanwhile, the QQQ and DGRO combination is the wild child of the bunch, offering high potential returns but with increased risk. So which combination reigns supreme? Based on historical data, the Vanguard combo, VYM and QQQ, takes the lead with its 15.8% average annual return. However, past performance doesn't guarantee future results. Your ideal combination will depend on your risk tolerance, investment goals, and market outlook. As we look to the future, each pairing offers unique advantages in an ever-changing investment landscape. Ever wondered how to turn investment knowledge into real wealth? Let me share a story. A friend of mine, Sarah, learned about ETF combinations but struggled to put that knowledge into action. She's not alone. Many investors stumble at this crucial step. But with the right approach, you can avoid common pitfalls and set yourself up for long-term success. Your investment strategy should be as unique as you are. There's no one-size-fits-all approach in finance. The key is determining your personal risk tolerance and investment goals. How do you feel about market ups and downs? What are you aiming to achieve financially? These factors vary from person to person and play a crucial role in shaping your portfolio. Once you've got a clear picture of your financial DNA, it's time to open an investment account. Platforms like Moomoo offer a user-friendly experience, especially for beginners. With $0 commissions and access to essential data and news, you can make informed decisions without breaking the bank. Now let's talk about dollar cost averaging. It's a powerful strategy that can reduce the impact of market volatility. Here's how it works. 1. Choose an amount to invest regularly, e.g., $500 monthly. 2. Select your ETFs. 3. Set up automatic transfers on a specific date each month. 4. Stick to this plan regardless of market conditions. Now let's look at an example. If you contribute $500 per month for 25 years and achieve an average return of 14%, you could end up with over $1 million. Compare that to a standard S&P 500 investment at a 10% return, which would give you about $622,000. That's a difference of nearly $400,000. To make this happen, consistency and patience are key. Set up automatic transfers to your investment account each month. It's like putting your wealth building on autopilot. Many investors falter because they lack patience. The 2 ETF strategy we've discussed combines high returns with a steady income stream, making it resilient against market volatility. But you need to be prepared to hold your investments through market fluctuations. As you progress, your portfolio might need adjustments. Your risk tolerance might change, or one ETF might outperform the other significantly. That's where rebalancing comes in. Remember, this is a long-term strategy. Those million-dollar results we mentioned, they come after 25 years of consistent investing. Stay focused, stay patient, and watch your wealth grow. Ready to take control of your financial future? Let's recap. A 2 ETF portfolio combines simplicity and effectiveness for long-term wealth building. Warren Buffett's wisdom reminds us that patience is key in the stock market. Imagine where you could be in 10, 20, or 30 years if you start today. About 80% of consistent investors in diversified portfolios achieve their retirement goals. That could be you. The power of compound interest is waiting, but you need to take that first step. Why not explore ETFs that align with your goals now? Your future self will thank you for the decisions you make today. Picture yourself on the path to financial independence. It all starts with action.